Of course, the big question at the moment that I'm asked is how do I protect my portfolio or my capital against inflation? If I just have it as cash, then obviously inflation is a worrying problem. There's many different ways to answer this, and I'll give you one particular approach which you can take. It doesn't necessarily mean it's the right one, but I think it's a pretty good one which should work well. And it's to start off here, and it's to take the things which are rising in price and instead of fighting it, buy into them. So we know, for instance, commodities, gold, and you can see here what I've drawn here is the 3-month performance of various exchange traded funds or index trackers, basically, which are a basket of stocks which are then tracked by these instruments. And you can see the 3-month performance, the 6-month performance, and ideally I want those performances to be positive. Volatility, I want to be under 10%, roughly. And part of the reason for that is I want less volatility in an equity market which is falling. And to give you a benchmark, Microsoft has a volatility of 10%, and probably the safest company I can think of. And these are under 10%, so that gives me a degree of confidence. Sortino, ideally, I want to be above 1. It's a measure of reward or return versus the probability or volatility of missing that, or the risk of missing that return. So if you've got a good high average return, but a big chance of missing that average return, then you've got a low Sortino, and you want a high Sortino. It's something we as hedge fund managers are asked, what are the Sortinos of our funds? And one way to just easily bump up your Sortino is to own a lot of things with high Sortinos. Of course, it's backward looking. The past is not a guarantee of the future, just as nothing is a guarantee of the future. Alpha, outperformance of the market, of course. But there's a couple of other things I want to show you. Correlation. Now, it's been correlation to the broader equity markets, and ideally you want correlation of 0 in an ideal world. Most people think, oh, correlation, diversification, I want correlation of -1, where 1 is moving in lockstep. I want -1. No, you don't, because then every gain you make on the equity side, you'd lose on something else. You actually want 0 correlation. Somebody won a Nobel Prize for showing that a basket of uncorrelated assets does better than trying to time correct movements in the same basket. So what might you come up with? Well, you may well, and I've given this as an example, this is not a recommendation to buy because I don't know your personal circumstances. Let's say you looked at something like this with commodities. You say, well, actually, I want something with good positive return momentum over the last 3 and 6 months. I want volatility under 10%. I want a Sortino. If it's not above 1, I want it, as high as possible, close to that. Good alpha. Correlation under 0.5, so that's okay. You might not pick this. You might pick something else. I'm just saying, there's a lot of data there. This is what I do for my students, and there's some links in the bio for all of this. Now, so you go into that. The great thing is all this information is widely available. I wanted to know Invesco Bloomberg Commodity ETF. Here you go. Went to the Invesco website, looked it up. They tell you the top 10 exposures, and I can see what they own. I'm not going to go out and buy each one of these futures contracts in copper, silver, sulfur, soybean, Brent crude, gold, natural gas. Commodity prices are rising. Energy prices are rising. If we continue believing that they're set to go in the same direction as they are now, food, corn, soybeans, well, this gives you a basket. And as you've seen earlier, it was up 45% in the last 6 months. Will it continue? That I can't guarantee. That I can't say. That I do not know. But if I had to make an educated guess, I'd say, yeah, probably is. And we need to have some kind of exit, so we might as well look and hold it for 12 months or 6 months. And if it drops 25% from the peak since I bought it, then I'll exit. So 25% trailing stop loss. Or you might say, well, I'll exit half of it if it drops 10% from the peak since I bought it. All investing is risky, as you know. But as I said, it's one way of tapping into the commodity boom. And this can go into ISAs and SIPs and tax-free pensions. Anyway, I teach a lot more about this. Just have a look at the links in the bio and you'll be able to see more about this. Thank you.